Welcome everybody to the, I don't even know, what is it, ninth Texas Multifamily Masters Chapter kind of combined meetup. I mean, I think we did the first one probably March or April, right? So let's say April,
May, it's been 9, but whatever. It's been quite a bit.
Yeah. November, so it'll be 8th. So we've done probably 7 or 8 of these.
Yeah, that sounds.
But for those of you that don't know, obviously we're all part of a group called Multifamily Masters. Really, that's a national meetup brand, right? Ben and I run the Houston chapter, and we have kind of our partners that run the Dallas chapter, and we'll have everyone kind of introduce themselves here in a minute. But really, we decided, hey, you know, with COVID, obviously meetups are kind of canceled for the foreseeable future. And rather than everyone doing their own online meetup because there's a million of them, we figured we can combine efforts to do something bigger, better than everybody else's. So, you know, for those of you tuning in for the first time, right, typically we do about 45 minutes or so of discussion, and then we do about 15 minutes of breakouts at the end, maybe 1 or 2 of those. Right. And so we really try to make these fluid, dynamic, and kind of entertainable. For us, real estate is all about networking, right? That's how we all know each other, and it's an important part of it. And so the more we can facilitate that with breakouts, the better. Right. And so I guess with that said, you know, this week we're going to do a little bit of a roundtable, right? We've been doing kind of introducing the different hosts, right? Last week, I think we had Ben, or last month we had Ben, John, and I think Ronnie. So This week we're going to have myself, Anton, and Neil. I'm going to moderate myself. No, I'm kidding. Ben, moderate the whole thing.
No, I'm throwing you some curveballs, buddy. Nice try.
Yeah, and so honestly, guys, for those tuning in, please, you know, this is really a dialogue for everybody else too. Ask questions. I know myself, Anton, and Neil, we're all pretty candid, transparent people. We're happy to answer questions, whether they're easy or hard. So please, you know, drop your questions in the chat, and Ben will kind of moderate those as well as kind of his own questions. So with that said, maybe let's do a really brief kind of introduction of everybody, all the leadership, and then we can go from there. So for those that don't know me, my name is Ferris, a company called Disrupt Equity, along with Ben, who will introduce himself here shortly. We kind of have properties throughout Texas and Georgia. We have our own in-house management company, and we're based in Houston, so looking to continue to grow, and we primarily buy CB, and also we're looking at A assets.
Yep.
So with that said, Ben, you want to go ahead?
Man, what else am I supposed to say? No.
That's
okay, so
thunder, right?
I know you totally took my thunder on that one. So yes, I mean, we've got about 1,500 units, folks. You know, we're looking to buy more. We haven't bought anything this whole entire year. We're itching to pull the trigger on something. Probably our next acquisition is probably going to be in Texas, but we do look pretty closely in Atlanta as well, and we're looking at a couple other markets. You know, we have property management in-house. We're partnered with Anton on peak financing. So we have mortgage brokering, you know, and Anton will introduce himself here in a minute. And then we also have commercial insurance too. So we're trying to kind of develop the whole stack. You know, hopefully construction and a couple other pieces are going to come together in 2021. But ultimately, where we get excited is acquisitions, right? You know, working with partners, working with brokers, working with investors to get deals done. So that's kind of where me and Ferris are trying to kind of get our world, you know, together and organized. So that's what we can kind of focus on. But, you know, I came from an IT background, sales and business development. And, you know, so it was a good segue into raising capital and talking with investors. So, you know, but excited to kind of hopefully do a better job or as good a job as my partner does on moderating. I'm going to be shooting it from the hip a little bit.
Set the bar high, man. Set the bar high. So.
No, man. No. So, but we'll have some fun. But I'll go ahead and I'll send it over to Mr. Neil.
Yeah.
Hey, good evening, everyone. Neil Bertrand. I've been in multifamily for about 22 years now. Been a VP of acquisitions, VP of operations, senior VP of operations. Worked with Ben and Ferris, watched those guys grow. It was really exciting to kind of see that in action. Working with Ronnie on some deals now, and just proud to say I know both John and Anton.
All right. Thanks, buddy. All right, so I'll go. I'm just going down the line from where I can see everybody in Zoom. So Mr. John, you're up next, buddy.
Hello, everyone. John Montero, based up here in the Dallas area in Frisco, Texas. Been investing in real estate for over 20 years. Started to pivot and move into multifamily about 6 years ago. I primarily partner and co-sponsor deals with a handful of seasoned operators in the Dallas, Fort Worth, Houston, and San Antonio markets. We have 3,400 doors under management, and have a couple more in the pipeline currently. Also, we do ground up construction. We've got a project in Katy, Texas, down west of Houston, as well as a project in Wiley, Texas, which is just east of Plano here in the Metroplex. Good to see everybody again today.
All right. Thank you, Mr. John. Mr. Anton.
Hi, everyone. Hi, Ben. Hi, Ferris. Hi, everyone else. That strange accent is from Switzerland. Most of you have heard me before. When you are in Switzerland, you are either into cheese, watches, or finance, and I happen to be in finance. So I grew up in banking, worked in New York, Tokyo, Hong Kong, and I've been living now in Texas for the last 15 years. I've personally invested in commercial real estate for around 30 years, and I've been involved on the financing side for the same time. As Ben mentioned, I'm a co-founder of Peak Financing. We have partnered up to get all the benefits from my knowledge and my colleagues' knowledge on the financing side, combined with all the marketing and IT knowledge that Ben and Ferris bring to the table. So it's an ideal match. And we arrange financing all across the country for commercial real estate. A big chunk of it is multifamily, particularly in the current environment, because multifamily is one of the few commercial real estate asset classes where financing has been readily available throughout the whole COVID-19 situation. As you can imagine, if you own a hotel and want to refinance, it's a little bit tougher, and that also applies to retail. So outside of multifamily, it's really just industrial and warehousing where it's very easy to get financing. Everything else is tough. So you're in the right spot here with multifamily because it's still rolling.
Thank you, Mr. Anton. All right. Last but not least, my buddy, Mr. Ronnie. Why don't you do a little introduction, man?
First, I want to say thanks everyone for attending our meetup. Glad to have a lot of active participation and looking forward to this roundtable. So I'm Ronnie Phillip with Kingly Acquisitions. We are a commercial real estate investment firm based in Dallas, Texas. We own in San Antonio and Atlanta, Georgia. So about 572 units. Our focus is primarily has been B and C class, but now we're moving into class A, 1990s product or newer. And yeah, looking forward to connecting with everyone.
All right. So you want me just to go segue right into it, man? Ferris?
Yep.
All right. Well, I'm going to try to do my best, everybody. Usually Ferris does a lot better job at emceeing, so I always have him do these types of things, but I'm going to give it a shot. Everybody that we're interviewing tonight, Neil, Anton, and Ferris have very, very unique backgrounds, right? You know, so I'm going to probably tailor some of these questions. They're not going to be one question and have three different people answer it, right? I think I'm probably going to have specific questions for specific people, right? So, you know, starting off, Ferris, man, you know, a lot of people know some of your story, right? But maybe kind of get into your story and how your background in IT and software development has kind of allowed you to do some unique things in commercial real estate, and you know how you kind of gravitated into that space.
Yeah. So for me, I think I'm like a lot of people on the call, right? Engineering background. I think most people that I run into real estate that had a W-2 before, most people are engineers, developers, kind of come from that world, right? Because I think it's a good fit for real estate, right? And so me personally, I was at Microsoft. You know, I love software. I still do. And initially left Microsoft with the vision of building software for real estate, for dated industries like real estate, right? A lot of smart people working on software problems at software companies, not enough people go to other industries. And so that was kind of the vision. Had a software company for several years and, you know, started just looking for other places to invest. And so, you know, kind of came across real estate, right? And ended up buying a fourplex, which is coincidentally a mile from our office. One day I'm going to take you to do a tour of that place. We just drive by it all the time. We never have done it, but you know, bought a fourplex, then bought a bunch of houses, got a good taste for real estate, realized it just doesn't scale very well, right? Then from that was going to do a 32 unit property in Conroe that I'm glad I didn't do. I was going to do that alone. And then, you know, really found out about syndication, right? Fell in love with it. It's people's numbers, systems, all the things that I like. And, you know, started Disrupt Equity, right? And we've been rocking and rolling. And I guess, What I've since realized, though, is the opportunity is not so much about creating new software for industries like real estate. It's about leveraging all the things that are normal in the tech world and tie it together in a way to kind of bring something differentiate you, right? And in real estate. And so that's obviously led to kind of a lot of what we've been able to do, right, in terms of growth and doing things differently, right, from property management, and really rethinking that business to even just how we do our asset management and property. So,
no, I think what you're not selling yourself enough, man. What Ferris has done is he's bleeding edge in terms of what technology is out there, just because he lived in that world for so long. And I think what he's done is he's been able to find what all of the other big tech companies are doing and slam it into our processes, which is a differentiator in a lot of ways for us versus some of the other folks out there, right? Because I look at commercial real estate, it's really kind of dated, not even just property management. Let's not even talk about property management. Let's just talk about commercial real estate, right? It's very kind of dated, old school, good old boy network. And, there's very few firms that really kind of adopt technology as quickly as Disrupt Equity has. But, obviously I just sold the stuff. He knows about it. So all this cool technology that we've done over the years is all Ferris driven. So I'm going to give you a little bit of a kudos, man. But all right, so I'm going to go to Neil. All right, buddy. So you have a ton of experience, right? Both property management and asset management, both working for kind of smaller firms plus bigger firms, right? So, kind of tell us where you're at and, what are the differences between kind of the syndication world, which I think a lot of the people that are on the phone tonight are really kind of in, versus kind of more the institutional way of doing things, right? And maybe a couple pros and cons there, man, that you've seen, because you've been on the ground floor on both.
Yeah. The good thing about syndication is literally anyone who educates themselves can do it. I'm pretty sure on this panel, we've got a variety of W-2 backgrounds, IT engineers, dentists, attorneys, serial entrepreneurs. So, like I said, in the syndication world, the great thing is anybody can do it. The caveat being educate yourself so you do it right. On the institutional side, I would have to say that it's much easier to raise equity. Because after you
why is that though? I guess is it is it because the people that you're working with though maybe have more experience than the typical kind of mom and pop syndicator?
Yeah, so you hit it on the head there, Ben. To approach a private equity group, you typically have to have so many years of experience, so many deals under your belt, so many full cycle deals under your belt. Private equity firms prefer that you be vertically integrated, so it's easier. Say if somebody like myself partnered up with two other guys like me and started a company, I mean, we could honestly, with our connections, go and start talking to private equity groups right out the gate, right? Just by virtue of the background. From the syndication side, you've got to build up to it. And, there's probably a handful of syndicators that have a track record, say like John, who could get in front of a private equity group. Ben and Ferris, you guys have done the right thing by vertically integrating, bringing your management in-house. That's very attractive to the equity groups. And like I said,
what are some of the, I guess, just so people have something to strive towards, right? Because I think in a lot of ways, we get into syndication and then the holy grail is private equity and family office money, right?
Mm-hmm.
And not everybody goes that direction. And sometimes people go that direction and they pivot and they say, I don't want to have any more of that money, right? But maybe what are some things that people are kind of, for the most part, is it you need to have 5,000 units under management or $100 million in assets under management? I mean, what is it that you've seen from some of the discussions that you've had with private equity and family offices that, people can kind of, hey, that might be my goal for the next 5 to 10 years?
Yeah, so typically, 3,000 to 5,000 units. A good track record. They're going to want to know that you've gone full cycles on deals. They're going to want to know what kind of returns you gave back to your investors. And the other thing to be keenly aware of is depending on the size of the check that the equity group writes, you're no longer looking at 75-25 or 80-20. It becomes 90-10. You get up to a 900 unit deal, that's a $55 million raise, and you're literally looking at 95.5, right? So it is a much different world. The term sheets are different, and one bad deal with a private equity group, and you are probably shut down for. Well, I know of one group that did it, and they were dark for about 8 years before being able to come back to life. So, and with the syndication side, I think you develop much more personal relationships with your partners. There's a huge difference between your investor being the guy that you're standing next to at your kid's soccer game versus your investor being a guy that's on the 16th floor of some Wall Street office. It's just a completely different vibe.
Gotcha. All right, man. All right. Well, thank you. All right, Mr. Anton. So, you kind of went over your background a little bit, right? Ex-banker, kind of followed, your country's, path, either banking or what was it? Is it chocolate or is it cheese?
Yeah,
One of the
chocolate, cheese, and watches.
There you go. Right. So
I mean, it's not really fair because it probably has one of the strongest pharmaceutical and engineering companies around the world, but that's not what Switzerland really is known for.
it's just like everybody thinks Houston is just all oil and gas, right?
That's right.
So I feel you. So, having said that, right, you were in that world for about 20 years, right? And so what we've noticed working with you is that you really you kind of look at it from the lending side, right? Whereas a lot of mortgage brokers, and I won't name names, are just mainly salespeople. And you do a pretty good job of selling yourself, but you also understand how these things work and how lenders look at deals, right? So how could you, your background, how has that kind of helped you morph into the mortgage broker that you are today, and some of the, the things that you've kind of learned and how to position things, because of that background?
Yeah. So my background, as I mentioned, is certainly unique for a commercial mortgage broker, period. I have a finance degree, then I worked in investment banking. I worked in corporate banking. So I was on both sides, investment banking, corporate banking. We did very large deals for multinationals across the world, extremely difficult to analyze. The deals were extremely difficult to analyze. And with that, I gained an insight in what all the various pieces are that really are important for a lender. I had to present to a credit committee essentially on a weekly basis, and we were grilled on a weekly basis. Initially as an analyst.
So some folks on the call might not have done a deal yet. So what's credit committee? And is it actually a committee, or is it usually just one or two guys and gals that are just making the call on these things?
Well, it all depends on the company. If it's a smaller lender, it might be just one or two people. They also have everyone has certain authorities. If it's, let's say, up to 5 million, maybe it's just one individual. If it's 10 million, maybe it's two. And if it's above that, it might be a group of a dozen, and you need to have at least 6 that actually give the approval. Sometimes it's all in writing, where paper is just, or electronic documents are just pushed back and forth. Mm-hmm. During my time when I started out, and that was probably the toughest part when I was an analyst. So you essentially have to prepare the paperwork, then it's being sent off to the credit committee, and then you have to go and present it live in a boardroom that's always on top of the building. That was in New York City, right? Very fancy offices, and all the senior guys there grilling you. And actually the VPs and managing directors, they knew exactly when they had to step back and let the analysts talk whenever it was something that they didn't really want to talk about. So I learned very early on what to look for and what potentially can derail a deal.
So the credit committee makes so just to kind of recap for everybody, right? The credit committee is kind of the approval body within the lender, right? That's pretty much picking holes in the deal. I don't like this deal, or what about this? And then they can come back and they can poo-poo the whole deal, right?
Oh, absolutely. Right. And now it also depends what kind of a deal it is, right? If it's a bank, obviously the bank has complete underwriting authorities. Once the credit committee, whoever it is, approves that deal, then it's set. Uh, with agency loans, it may or may not be the case, right? For Freddie, for example, even though it goes through a credit committee, that deal still then has to be presented to Freddie. And Freddie essentially does the same thing. So they also have the underwriters, then they have the senior underwriters, and the whole package goes to their senior officer and credit committee, depending on the size of the deal, and they do exactly the same there. So for these deals, essentially, it's underwritten twice and approved twice. For Fannie loans, it's a little bit different in most instances because lenders have so-called delegated authority for all or at least a majority of the deal, where they may have to ask Fannie for certain waivers, and once they're approved, then they can do it all in-house. But the process clearly is when you talk to a originator at the lender, they do not really have any authority, right? Then it goes to the underwriter, and the underwriter still doesn't have an authority. So it goes up the chain all the way up to the credit committee, which may be just one person depending on the deal size, or it might be a whole group of people.
So your experience having been on that side of the table, right? How has that made you a better mortgage broker, right?
I've tried to look under every single rock that is out there and predict where potentially something is hidden beneath a rock. I think that's probably the most value I bring to the table, because there are not many things that I have not seen. And even if I have not seen them, at least I think I have a better nose to anticipate them. So when I look at the deal, I think ahead and kind of anticipate what potential issues could come up, whether it's at property level, whether it's market level, whether it's sponsor level, so that hopefully we do not have a retrade because we missed something that was once you look back, you would say, oh, that was kind of obvious. Why didn't we think about that?
Yeah. And I think, one thing that just to point out that to everybody is you're probably, you do a great job of under promising and over delivering, right? And I think the other thing too is you also talked us off the ledge on a couple deals too, picked holes in it in a good way, right? Just kind of pointing out some things that a lender, would point out once it really kind of got to that point, right? And you kind of saved our shirts in a couple of different ways. So
yeah, so
cool.
I think it's important, right? We never tell any sponsor not to do a deal. But we point
You've told
out.
us. No, I'm not. Not in so many words, right? But I'll reread your email several times. I'll be like, he doesn't like this deal.
Yeah. So essentially,
correct.
with in between the lines, obviously, you probably hear when I don't like a deal, but I certainly will communicate in all cases whether I feel that it will be a challenge and where the challenges lie.
And for the record, Anton almost never. I've never heard Anton say he likes a deal.
There's been some that he's been more bullish on than others, right?
Yeah.
But
he's been less holes poked as others.
There you go.
But it's good. We need someone
that's good because
straight to the point on everything, right? So that's important.
And I think this is a good segue. This is going to be my next round of questions here, and it's going to go to you, man. So what we're all talking about, what we all want to do is we want to do deals, right? Whether it's syndicating or using institutional equity or whatever it might be, right? I think everybody that's on here is either currently doing deals or wants to do deals. So I'm going to kind of spin it in each person's direction, right? So for Ferris, right, we haven't stepped into the institutional equity world. Maybe we will in the future. We'll see, right? But we're currently syndicating, right? So, but you're kind of on the acquisition side of our business. Kind of tell us what you're seeing, what's happening in the market, what are the brokers saying, and ultimately both me and you talk to a lot of investors too. What are people doing, right? What's happening right now?
Yeah, so I'd say, obviously we focus a lot on all the primary Texas markets, as well as a lot of the Atlanta markets, right? And so really in both markets, even in Houston, right, you're still seeing pretty much cap rates stay the same or even compress, right? with interest rates falling, we've seen prices tend to either stay or go up in some cases. And so add to that the fact that there was basically a lull during the summer, right? Kind of March, April, May, June, some of July, right? Not much got done. Then a lot of deals got dropped. And really, you have guys, some guys are finding genuine deals. We have other guys that with pent up demand, right? They're getting aggressive. Plus, interest rates have fallen. It's made it even more attractive to step up on some pricing. So, in general, we've seen pricing go up. We've seen cap rates stay the same or compress. And, it's hard to do a deal. And then maybe couple that with all of that pent up demand went, right? July, August, September. And now we're kind of reaching the holidays, right? So, pretty much the last of the deals are kind of getting, going under agreement, getting wrapped up. And, there's not really going to be much for the next month or two, right? There's going to be some deals. Obviously, we're looking at a few, we've made a lot of offers, got close on a lot of deals, but there's just not as much inventory, right? As, people are waiting until January. So I think, everyone is trying to do the rush before the election. Now, election till the holidays is going to be kind of, dry, for lack of a better word. And then, come January, right, I think you're going to start to see a lot more pick up. And I think with a split Congress, right, I think really that just means things might probably stay the same, right, regardless of what end of the spectrum you're on. And so that just means, continued interest, right? Multifamily has proven itself and continue to get more momentum behind it. And I think
just to kind of recap, right? So you're seeing demand for product is still there. Obviously, there's a ton of equity out there. There's a ton of people that are interested in multifamily. Obviously, that's apparent. We've got 78 people on tonight's phone call, right? But what you're saying is supply is pretty limited, right?
Yeah, it definitely is dried out. And then maybe the other piece to add to that, what's been interesting for us is, you're seeing a lot more deals where they need to be assumed. That's right. Correct. People locked in what they thought was a great rate. Anton didn't warn them that the rates were going to fall in a year. And so, rates fell. And so they're stuck in their loan with a big prepay yield maintenance, just like we are with some of our deals, right? We're cash flowing, we're fine. But, some guys aren't, or some guys, want to sell and they need someone to assume. So we're looking at a lot more assumptions, a lot more than we've ever looked at, right? Some of them are duds, some of them aren't, right? And trying to figure out that kind of thing. But that's been definitely a shift, right? With just so many more deals. And, that leads to potentially nicer deals that we also look at, right? So that's maybe the biggest shifts that so far what we're seeing, right?
And Tom, we won't fault you for not having your crystal ball, all right, buddy? But hey, so I'm going to pivot over to Neil, right? So once again, I'm going to I'm putting you in your institutional world, right? What are the the private equity guys? Are they still on the sidelines? I mean, what we're seeing here in Houston is obviously Houston, for a couple different reasons, they kind of pulled out, but we know that there's a ton of equity, both at the Wall Street level as well as on Main Street. What are you kind of seeing from deal flow to equity and, kind of supply and demand that's going on in your world?
The private equity groups are still looking. I spent all day yesterday in Houston, out there by you guys with a managing partner for a Chilean equity group. Okay. And, the one thing he kept repeating was, I got $100 million to place. We want to do it in Texas. We want to learn more about Atlanta. I've spoken with other private equity groups who were, pretty much saying the same thing. We've got a mandate to place money by the end of the year. The one thing with the private equity groups is that they typically, they won't adjust their expectations, their return expectations to the market. They'll just go out and find a new market. So that's one thing is if Dallas isn't looking good, then they're going to go look for the next Dallas, right?
So let me ask you a question, man. A follow-up question to that, right? You said their expected returns, right? Why don't you educate everybody on what you're seeing from that institutional equity? Mostly for what we've seen, right? And correct me if I'm wrong, they're IRR driven guys for the most part, and gals. Yeah. What are they looking for in terms of return?
Yeah, so minimum 15 IRR and 8 to 9 cash on cash. Typical 5-year hold is their plan. They really don't like to, they want to get in and out of the deals within that 5-year time frame. But just talking with some of the groups, even a group out of China, looking for A deals. And the other thing I'm seeing in the institutional side is a lot of new development, a lot of new construction that is at the tail end of lease up coming on the market. I mean, there's a lot of Class A product I'm seeing in Dallas and Houston, Atlanta, every place that's been built, those guys are trying to sell now.
Yeah. Yeah. And so bottom line, you're still seeing a ton of demand then, right?
There's a lot. Yeah. There's a lot of product out there, and pretty much in all classes as well.
Okay. Okay. Yeah, that's kind of what we're seeing too. So I think across the board, the world is awash with cash, right? And they're looking to deploy it into good deals, both at Main Street and Wall Street, But so Anton, right? You see all sides of the world, right? And you kind of pointed something out in your intro that was interesting, and I want you to kind of take a little bit deeper dive of it from kind of the lending, mortgage brokering side, right? We're all on this because we're interested in doing more multifamily or just getting into multifamily, right? Talk to us a little bit about the lending side and why multifamily and some of these industrial, some of these other things have held up through COVID, and what you're kind of what you're hearing from Fannie and Freddie and the lenders, kind of going into 2021. So not necessarily from the acquisition side, but from the lending side in terms of deals and what they're looking for.
Yeah. So certainly for a short period in March, everything really shut down, including multifamily. There were agency lenders that could not fund their deals because the so-called warehouse line, as it's called, from their lender was essentially frozen, right? So you need to understand, even though you talk to a lender, they still depend on other companies and other banks to fund them for the deals before they can sell that loan to Fannie or Freddie or into the CMBS market. So everyone is essentially interrelated, and if the capital markets freeze, everyone is suffering. But outside of that, once the capital markets opened up again, everyone realized very quickly where the pain points are going to be. Obviously, retail was quite obvious. Hospitality was very obvious. Offices, no one really knows, but it's a much more slow-moving asset class to start with. But what everyone quickly recognized, that multifamily, after the first month of a little bit of uncertainty, it was doing much better than everyone was fearing. And it continued month after month. So agencies, while they initially put up quite a bit of restrictions in additional cash that had to be put in escrow for principals, interest, taxes, insurance, that they pushed a little bit that down. So now we still have the principal and interest in place for both Fannie and Freddie. Some banks also have that HUD is still at 9 months of principal and interest. So that is definitely in place, but overall the lending environment is extremely positive for multifamily, as long as obviously the deal makes sense, particularly when it comes to stabilized properties. And that is one of the reasons why that rush to stabilize properties is now probably more pronounced than ever. Right, in the past, you and many others looked at distressed asset or slightly distressed asset that had a value add component to them, and you went into a bridge loan with the anticipation that it would be able to refinance into an agency loan. Well, with COVID-19, a lot of bridge lenders that went out of business, and the ones that are back in, they are more conservative. They can pick the deals that they like, the markets that they like. So it's much harder to get decent bridge loans compared to pre-COVID-19 times. And as a result, whenever there is a deal that is doable under an agency loan, everyone rushes in. And that's what you and all the other syndicators and buyers have seen, that you now have essentially have a situation where prices have not come down. They have contracted maybe 5-10% during a brief period of time, but now we see record prices, right? Now compare that with hospitality. You cannot even come up with a price because you cannot value them in a lot of instances. And
is anybody lending on hospitality, or is it complete? I mean, and I feel sorry, and don't take offense to anybody that might be on the phone that's invested in one or has one, right? And I actually feel for the hospitality vendors. but I mean, is anybody in there lending on hotels?
Yes, just at the very low leverage, right? And we
Okay.
talk about essentially one looks at the current income stream. Is the current cash flow supporting it? Then they may move it up a little bit, and then you need to escrow the interest reserves for a certain period of time. And it's also for experienced operators that know what they are doing, right? So, like I was involved in a portfolio acquisition of limited service hotels after the Great Recession, and there the situation was very similar, not as extreme now, but it was still similar, where financing was not readily available. The economy was still doing bad. All the hotels that underperformed. So you had to come in there with 50% plus in equity. And that is still the case now. It's anywhere between 50 and 60% of equity that need to come in.
Me and John Montero will be lending for hospitality at a 25% interest rate and 50% LTV. So if anyone's interested, let us know.
Ouch. Yeah. Ouch. We're not doing hard money loans here. All right. Come on, man. All right. So, because I want to be respectful, and I think everybody's here. They also want to do a little bit of networking too. So I'm gonna throw the same question at all three of you guys. You guys have got about a minute each to kind of do it, and then we'll do some breakouts here. So, all right. Politics aside, let's say what Ferris said is true. We Republicans, retain, let's call the Senate. Biden's gets elected, right? What happens in 2021, for our industry? And let's just use multifamily, if anything. And then on top of that, secondary question, right? What's your goal for 2021? Ferris, I'm going to throw that one at you, man.
So the first part of that is it a split Congress?
You weren't paying attention to me?
No, I wasn't. But is it a split Congress or not split Congress?
No, it's just split Congress.
I think nothing changes. I think we're back to 2020-ish. And, assuming another stimulus gets passed, right? But I mean, I actually don't think things are going to get worse or dire or anything like that, right? And
even think maintain, it's going to be kind of the same.
It's going to be status quo, kind of what it is, right? And, continuing on. I just don't. There's just too much momentum, I think, behind it. And, we'll see, right? I might be wrong, but, ultimately, kind of, who knows what the next year looks like, right? The next 6 months. But I think, even in February, right? People have an outlook that, hey, come December, everything will be back to normal, right? And so that's going to keep the February momentum going and kind of going on from there.
So so having said that, right? What's your goal, man?
I mean, I think 2021, I think we're probably going to go on a buying spree Q1, Q2, right? I mean, just being patient, trying to find the right deals, but really, obviously we've been rejiggering the entire acquisition pipeline and how we do that, right? So really expanding to more markets, really getting more things systematized, more things underwritten, more things looked at. And so, I think obviously for us, it's to buy probably, 6, 7, 8 deals if we can.
I thought we were buying 10.
But if we can't find a deal, I mean, we won't buy anything, if we can't find something that makes sense. So
we're trying to buy 10, man. Come on. That was an easy one for you, man. Come on. There was the one right up the middle for you. But anyway, all right. Thanks, buddy. All right, Mr. Neal, throw in the same thing, man. Politics aside, let's just use that scenario. What happens in 2021, and what's your goal, man? For 2021, your biggest goal, right?
So, again, like Ferris said, with a split Congress, there's going to be a lot of roadblocks. Anything that would happen to affect real estate negatively. The only thing I can see is if there's an attempt to have a federal stay-at-home mandate for 30, 60, 90 days. Doubt that would happen, but even so, we're looking at probably another round of stimulus and unemployment, so everybody can still pay their rent, right? But I agree with Ferris. There's really not going to be a huge shift one way or the other in 2021. That's just kind of my opinion. Goal for 2021, I've kind of realigned my focus and strategy. So looking to pick up 3 to 5 deals, wanting to do those in my backyard. Given the fact that I use a 36 tab underwriting model, I can't underwrite everything that comes across my desk. So just if it passes the back of napkin, then I'll do a deeper dive. But 3 to 5 good deals here in the Dallas-Fort Worth area to begin with.
And Neil is great underwriter, everybody. So, obviously he's not, he knows his stuff when it comes to that. So even a back of the napkin is probably better than what most of these guys are out there doing. So, all right, buddy. Well, thank you. Thank you. All right, Mr. Anton. All right. So same question to you. Do you see anything? If it's just status quo, is it going to change? Is it going to get worse? And what's your goal, for 2021?
Yeah, I think obviously it has, as what Neil was mentioning, it has a lot to do with where COVID-19 is going, assuming that we can keep it reasonably under control and or have stimulus packages that will support the economy until we have that vaccine in place. I do not really see a deterioration. With Biden and a split Congress, I think we probably underestimate how positive the economy is going to do next year and the following years. I know.
So you think this is so just to recap, you think that's a positive thing?
Yes. Yeah.
Okay.
So I think Biden is much more moderate than what people think. He will reach out across the aisle. I think he will reach out to world leaders that will get a boost across the board. And remember, I think we have a pent-up demand that everyone wants to get out there and do business again and live again. Now, as a result, we may have still a little bit of a dip right in towards in the first quarter or the second quarter. But I think when you want to go on a buying spree, you better get going because I think that we will have a recovery that will be really strong. And with that, I also, while everyone thinks that interest rates will stay low, I do not believe that. Right, so I think we will
You're
see.
calling your shot, buddy. All right, we're
and
gonna
again,
come back to you in 6 months.
Look, you asked me to have a crystal ball, so that's mine.
No, I love it, man. I love it. So, okay, real quick, what's your 2021 goal? So everybody knows.
Grow the business, grow peak financing, also focus on investing personally. And again, I think, as you said, right, I'm very skeptical when it comes to investing, whether a deal makes sense. And I grew up in an environment where high double-digit returns were the norm, including multifamily, right? So I'm still kind of tainted from that time. But I think next year I believe will be good opportunities in multifamily, but also in other asset classes, commercial asset classes.
All right, name one that other people should be looking at?
I mentioned it before, hospitality.
Really? Okay. All right. We're gonna come back to you in 6 months, man. We're gonna see. All right. So I'd encourage.
Hospitality is booming. So
we'll see. But all right, Anton, how can everybody reach you? And I'd encourage you to dump it into the chat as well, but give everybody your contact info.
Sure. Yes, I posted it in the chat. Anton at peakfinancing.com. That's the easiest way to reach me. I'm active on Facebook, LinkedIn. My phone number is 972-725-7878.
Oh, you gave the phone number, buddy. Now you're going to get blown up. And you do all commercial, not just multifamily, right?
That's correct, yes.
All right. Thanks, man. Thanks. Mr. Neil, what's your contact info?
Yeah, so email is Bertrand at lloydjonesllc.com. Cell phone 972-849-5707.
Very bold, Neil, giving that cell phone out. All right, man. All right, Mr. Ferris, contact info.
Ferris, Feris at disruptequity.com. If you need my cell phone, send me an email.
Ouch. No, he's very approachable, everybody.
I'm very
he just keeps those things close to the chest. But no, thanks, guys. We appreciate it. Hopefully everybody that was on got some value out of it. So I want to spend a few more minutes. We kind of do some breakouts because I think the bigger value here is obviously getting to know everybody, creating some relationships. This is what these events are for, right? It's not all about hearing a speaker, and you're not going to learn everything about the business, in 20, 30 minutes. So, but you might be able to develop some relationships in that time. So Ferris, you want to do a breakout here, and then we'll come back. We'll see still if we want to do a second one, but we'll probably, you want to do 15 minutes on the first breakout?
Absolutely. Let's do it.
All right, everybody, hang on, and we'll get into a breakout session.
All right. I think we got everybody back.
I didn't feel like 10 minutes, man.
Man, I gave you 12 that time. All right. I gave you even more. Jeez,
think
man.
I think once again, I might have talked to 11 of the 12. So I apologize for everybody that was in my breakout.
We'll give everyone a tip next time if Ben's in the room. You know, make sure he goes last in the turns of who introduces himself. But let's go ahead and call it a wrap. So
yeah, no, another good event.
Kind of that stuck around. Hopefully, people got some value out of that. Right. Again, networking is a big part of this. For those that are coming in for the first time, right? Obviously, we've been doing these Texas MFM meetups monthly. I think we're going to do one next month. We haven't kind of found that, but we'll definitely communicate that to everyone. We'll probably do a holiday themed one, right? We'll have Ben grow a beard, wear a Santa hat, and
you never know.
So we'll figure out kind of a topic for next one, and I'm sure everyone on here will get the emails and the updates. But thank you all for coming on out.
If I could just say, anybody that wants to save the chat, you can save the chat. If you go down to the bottom right, there's 3 dots. If you want to, if you didn't copy
that is a solid tip, my friend.
Okay.
That is a solid tip. Thank you, Mr. Greenberg.
So quickly do that before everybody disappears. But anyway,
yeah, we'll give you guys another 30 seconds before we close out, because that's a great tip.
Good seeing you guys.
Thanks, everybody.
Thanks, everybody.
Bye.
Thanks, everyone.
Bye. Thanks.
You guys.
Bye-bye.
Bye-bye.
Thanks, everyone.
Thank you.